Episode of the Innovators Investors Podcast. I'm your host, Kristian Marquez, founder and CEO of FinStrat Management. Really excited because with us today we have Romy Kochan, who's the general partner of Francis and Capital Partners. Welcome to the podcast.
Well, thank you for having me, Christian.
So we'd love to start with a focus on Francis Ann. What's the firm's investment thesis?
Investment thesis is squarely and deliberately focused on customer acquisition strategies. So we cross a lot of industries, or some would say we're a bit generalists. So we like to say that we're looking for teams and founders, whether they have the next unicorn tech play to offer or they're offering a pet rock. We're looking for teams and founders who can sell that product to customers, and that customer acquisition strategy is going to not only develop and keep revenue but grow that revenue up to a 10x level.
Okay. And we'd love to hear what was the genesis behind the idea of focusing on this segment of the market.
Well, it's probably an amalgam of a lot of experience working with portfolio companies over the last 15 years in the private market. We've seen more than 300 transactions, been a part of those in some ways from big to small. And it started to occur to myself and the other general partner, who's also my sister, Natalie Hazen. So Francis and Ann, that's our middle names: Romy, Francis, Natalie, Ann. So we've seen quite a few transactions, and without question, it was the teams who knew how to sell. Revenue, revenue, revenue. And it's a bit countercultural because in today's world, there's such an emphasis, particularly in private venture capital, early stage syndication, to focus on products and features, and how are you incorporating AI, and how are you doing the next, bells and features that's going to put a moat around your project. But the reality is, we have harvested incredible returns off of businesses that are not the next unicorn, but they
Hmm.
sure know how to sell and they sure know how to get customers. And we've watched some of those customer strategies weather businesses through things that were unforeseen. And so as we, continued to lean into the thesis that we were going to do for this particular set of funds that we're working on right now in Southwest Florida, Southwest Florida had largely been unmined and
Well,
still has to this day. There's very little venture activity. There's a lot of probably wealth here and investors, but they're not necessarily mining for deals in Southwest Florida. So we thought, how could we use something that we're both very good at? Natalie and I have been in a part of a lot of turnaround transactions and kind of small scale M&A, and what were the businesses that did well and the teams that did well in our particular history that we had personal track record experience with. And the common denominator was those that kind of won the story, tried and true, were those that knew how to sell to their customer. They knew their customer, they know how to sell to that customer, how to get that customer to repeat buy, make their stuff sticky, and how to keep that customer through good and bad times.
I'd be really curious to get your perspective. And if we were to start to break down companies, obviously you need a vision in order to execute against, but sometimes products or services are in the right place at the right time. In your perspective, how are they weighted between the two?
So you're asking me in terms of timing. Would you repeat that again?
Yeah, so from a
Great.
success perspective, there are absolutely some really polished founders who possess the ability to close. And then the proverbial, you can sell ice to penguins. But then sometimes some products or services happen to be in the right place at the right time. I'm a book of walking bad analogies, but one of them we can say face masks during the pandemic. And so, over your career, I'd love to know how you weight those two.
Mm.
Do you put more emphasis on the team, or do you put more on the product or service?
Yeah, and for these funds, we now clearly prioritize, and we've got it down to almost uh, a percentage within the due diligence season. So we prioritize 80% of our time and focus goes into understanding the customer acquisition strategy. And so we don't throw out the other 20%. We still have to do the typical due diligence on the product and market fit and all of those things. Of course, you don't want to um, just a high moment. Although we did invest in somebody during the mask season that was producing masks and had a good short run, so we have been a part of those, like, what we'll call a fireworks moment, but they have to have that team still has to have the ability to do more than one flash in the pan moment, and we find a good team can pivot, because a good team can and should pivot, because customers aren't robots. They are all living their lives and have all of these life events that change their customer profile as well. It's customer acquisition is a living, breathing thing that needs to be updated all the time versus a here's my customer profile for the next 3 years. Those days are long gone post the creation of the internet and digital media. So it's a constant evolving team that needs to be agile. So back to the original question, the we 80% of our time during due diligence is spent understanding the customer acquisition module. So much so that we went ahead and created it started out as an online set of forms into 6 different modules so we could deeply understand if their team deeply understood how to get the customers and what the nuances were for their particular market. That shortly, and probably by the time this podcast airs, will have turned into an app. That app now is called CamX Pro, CAMX Pro. That will be live and running by the time this airs. uh, we realized as we started diving into the due diligence section and spending the good 80% of the time, we thought at first that was 50%. But if we were really going to understand it and verify and do some full scope due diligence that would not only benefit us, but also potential other co investors, that we needed to become professionalized about how we were doing the due diligence. And one of the weirdest aha moments we had was that we found out a lot of venture capital angel groups absolutely hate that portion of due diligence, verifying the customer acquisition side of it and verifying their customer traction, and because it feels like this elusive thing to get your arms around. And we even found that some VC firms actually felt bad about asking this, which is probably the number one thing that the business needs. I mean, they could have a phenomenal product, but if nobody sells it, we don't have a business here, right? So that was a real surprise to Natalie and I about 5 months ago when we started to see that that was a recurring theme, and the relief that maybe part of that due diligence was done for them. And that's when we decided to turn this thesis into a bit of an app to help other investors handle that as well. On the
Right.
flip side of that, go ahead.
No, I was just commenting. That was brilliant.
Yeah. So we started to turn it into an app so we could go faster. And then as we'd give a final report to the portfolio company that they could use in their data room, the portfolio companies were reporting back that they were unlocking other investment that they were unable to get. So we thought, well, we're onto an early version of a product here ourselves, but really the intent was there's very little tools out there to help a potential investor really, really understand the customer acquisition from A to Z with all of the nuts and bolts in it. I'd love to say just one other thing about this. I'd be remiss not to mention the early inspiration for this that Natalie and I often referred to. There was a man named Gary Dahl. I mentioned the pet rock earlier in the 1970s, like summer of 75 or 76 or something. Pre-internet, he and his team sold 1.5 million pet rocks pre-internet at $3.95 each. Like, it was a pet rock, and granted it was a novelty item, but they knew and had done research of who would buy such a novelty item. I think their cost was like 30 cents or something on it. Today's equivalent of that, they sold it in the first 6 months of release. Today's equivalent of that is $30 million of sales.
Um,
So there was a team that did that pre-internet, and we're looking for teams that know that customer so well so that when they go to market, they're hitting it. There's pre-selling, they're hitting it. It removes it removes the heavy need of having such a moat around your product that it removes some of the fear.
and you may have mentioned this at the beginning of the podcast, so apologies in advance, but do you find then that your expertise is best aligned with direct to consumer, or are there enterprise applications as well?
Both. Uh, There's still a customer on the other side, so B2B, B2C, either way. Um, we love investing in B2B because sometimes the check sizes are a bit bigger for their customers, but no, 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 it's the same principle.
And so, without revealing any trade secrets, so if you're willing to comment, how much of this is psychology and an understanding of human behavior, in order to get someone to say yes?
To say yes to buy somebody's product, or
Yes.
I I would say uh, psychology always plays, but I prefer to use the strategy of preparation. Preparation. You get into the psychology, and it feels like some people rust against that because they're like, oh, it feels like manipulation or something. But preparation can take you a long way when you may not have the exact right word to use, or the
Mhm.
preparing ahead of time for what, and understanding and doing your research about who's your customer and what do they need, so that you are coming forward with a solution that's meaningful to them. Preparation, I would say, is more important than psychology, but psychology is one of, I mean, you must understand what your customer wants.
So said another way, if I may, it's not only knowing your value proposition, but assuring that you've identified the right person, such that there's alignment with what you have and what they need.
That is my personal opinion. I mean, with the internet today, it's presented as, the opportunities are endless, but so is the potential for waste of your time. This whole spray and pray method. I mean, you can spray all over the internet, but not sell one item. So, how do you know, constrict the noise out of it and make a targeted sale to who, and target who your profile is, and get to know your customer so well that you can
Yeah.
almost read their mind. A lot of communication, a lot of preparation goes into curating the relationships with the customers and understanding them.
So it makes complete sense. And so I have a thesis that if I were to start looking at some of the financial metrics of companies you've invested in, I presume we'd start to see, lower than industry averages on customer acquisition payback periods, because they're better targeting some of those businesses, and maybe higher customer lifetime averages and return on customer acquisition costs.
That's what we'd like to see, or would like to see, and or that increasing over time,
Yeah.
because that's a thesis of our fund. We always want to be encouraging our portfolio company leaders to be thinking about this, and what else can we do to help support them? Can we pay for some PR for them on their target profile? What can we do to deeply encourage efficiency when targeting their customers, and to continue to um, make space for continuing research, ongoing communications with their customers, ongoing feedback loops, so that they're always consistent and current. What our clients needed yesterday might not be what they need 2 months from now. This is one of the unexpected costs, I think, of doing business in today's world, is that just when you feel like you've found your footing and you're hitting the mark, the world flips
Yeah.
around on you, you know?
Yeah, I mean, it makes complete sense. I mean, the information is so fast, and whether it's intentional or not, I mean, preferences change. Competitors now can adapt quicker, and I think your point is really well taken. I don't believe it's possible to be. I mean, you can be, I guess, rigid on vision, but you can't be rigid on execution. You get your lunch eaten. Um, if we take a moment and step back from the firm, would love to know what your career looked like leading up to starting it with your sister.
Yeah, sure. I'm a bit older. I'm on the end of the 50s age band, so I've had some time to accumulate a resume. But I did spend my first 24 years in the public markets as a financial advisor, wealth manager, financial planner before that was cool, you know. So early on, got into it in 1988, and loved the problem solving aspect of it. But really, in 2007, I started to develop a deep interest in businesses that were starting to do good with their money. They now sometimes they call them impact businesses. Back then, I was on a mission trip in India and they were calling them mission based businesses then. But essentially, these businesses that were entertaining, trying to do something good with a profit, or intentionally setting up to hire businesses with people with barriers to employment. That fascinated me because on top of the normal high failure rate of small business, you add a layer on of a do-gooder element sucking up all of your profits or most of it. Now you just increase the failure rate over a 5-year period from 50 or 70, whatever you think it is, up to like 90 or 95. And that seemed like a fascinating puzzle. And I grew an aggressive curiosity around these businesses of whether they could make it or not if given good funding, good standards, yada, yada. So finally in 2011, my broker dealer said to me, "Look, we're so proud of you for running around the world wanting to save the world, but you got to decide public markets or private capital." And a year later, I sold my practices in April of 2012,
Okay.
and we started one of our companies called Gingrass Global. And that's largely a services firm that provides back office administration and reporting to either impact focused private capital funds, whether they're an informal group like a small set aside at a family office, or a church group that's put some cash together, or it's a formal Reg D, venture capital, private equity. If they've got some sort of focus in addition to returns of trying to move the needle on something good, we would back office that fund, which is a bit of a complicated mess, but we became a specialist in that. And that launched off into a couple other things, but they were all largely support. And through that, we saw a lot of things that were good and bad with portfolio companies. During that season, Natalie started a skilled trade fund, first one in Michigan. We were in Michigan at the time. Everybody agreed we need more skilled trade. Nobody agreed that you could make money as an investor through an investment fund off of it back then. Now today, PE funds are scooping up the
Sure.
cash cows of the of the plumbers and the electricians, but HVAC. But it wasn't that way, when we started it. So we started a pilot of skilled trade, invested in 4 small companies out of Detroit as just a pilot. Could we harvest any returns and help them be better off? And within 4 years, 3 million of wages were created, and a good return, and like, okay, we know how to do this in skilled trade. We'd periodically help do a lot of transactions for individuals, and pretty soon we had done several hundred transactions, individual ones, everything from somebody who wanted to buy a bus for a goat farm So the male goats could go goatscaping up to a $50 million, somebody needs a guarantor position because it's going to renovate a small downtown on this deal. And so we cut our teeth on a lot of projects that people said couldn't work, wouldn't work. And that's really probably also where this customer acquisition got cemented into us, because there's sales is always an oil of grace. If there's sales and revenue coming in, you're not dead. You can renovate, you can keep going if somebody wants to buy what you're offering. So during that time, we saw all kinds of things. Eventually, we were invited down to Fort Myers, Florida, to help teach a local community foundation how to do some impact investing. And through that, they asked us to start a venture fund for them for $50 million. And we kind of got it all set up. And at the 11th hour, they had a leadership change and said, "Would you guys take this over?" Natalie and I had always envisioned maybe in 2030 we would do Francis Ann. That would be what we'd sort of retire with, our last hurrah. And we kind of looked at each other and says, "Well, maybe we're going to fast track this a bit psychotically." Uh, the,
So,
psycho- the psychotic moment there was that Natalie and I are no strangers to capital raise, and we know how difficult it is because we'd been a part of many, many
sure.
VC funds raising it, and we see the back office of all these and know how difficult it is. The psychotic part was that we were not networked whatsoever in Southwest Florida. Like, it's one thing to try to use your network you've built for years and years to help you raise. We had zero, and we decided to do it anyway. So we're now raising for two $20 million funds that are just focused on Southwest Florida
Hmm.
founders, or founders that are selling here that benefit Southwest Florida, because it's the very first venture capital fund ever to land here, even though there's an extraordinary opportunity. So there's one equity fund and one debt fund, and we're close to opening the equity fund about 18 months later.
Wow. Uh,
So that's it
um,
in a nutshell. There's more along
that's,
there, but you get the gist.
well, I mean, when you talk about fun and exciting, and I have to imagine that that time you spent as a financial advisor really helped you have an appreciation of how precious capital is and the significance of doing your homework before you deploy it. Um,
Yes.
that's brilliant. So, you know, okay, so coming back full circle, you're now operating Francis and Capital Partners. You've come up with what sounds like a really unique and fascinating way to evaluate businesses. Now, checks cut. Would love to know the degree that you prefer to get involved with your portfolio companies.
Yeah, so we're super old-fashioned venture capital, and meaning like we're not PE like at all. We don't want to own more than 10% of these companies. We truly want to use them for a lift to the next level. Uh, you know, we want to be a part of the adventure of getting them lifted within 3 to 5 years to their next exit partner or acquisition partner, next refinance out. So we want to stay less than 10% of the ownership. That's a first important marker. The second marker is that, in terms of control, we view like ownership, control, and support, three separate areas. So ownership less than 10%. Control, do we want a board seat? Uh, we want someone who has a board seat that could represent us. So if we don't have a board seat, we do want to see an independent, someone not from inside their company representing the investors. We're okay with that as long as we're comfortable with that investor and we feel like we're going to get good communications about the company. So that's kind of a nice breath of fresh air for a lot of founders, that we're not going to force our way in onto their board as long as we've got a good communicator there representing us. In terms of support, we feel is the most important thing. We're a very active manager. We only want to see about 20 to 25 companies in each of our funds, and maybe even 18, depending on what they need, because post first investment, we want to make sure that we are supporting their customer acquisition and however we can do that. So initially after we invest, we give them a little bit of a quiet period to get that money to work. We're not going to sit over their shoulder and do that, but we do want a minimum of quarterly communications with them in whatever way works best for their type of company. Usually that's a one-on-one. Of course, add us to whatever your normal investor communications are. Um, but minimum of quarterly. Those that we deploy, because we deploy an initial check size, and then to the top performers in the first 18 months of our fund, we deploy an identical 1 to 1.5 times another check, similar, or 1 to 1.5. And then we also start to pay for promotion, PR, for them to get in front of their target customer. So other things that we will do during that time as we deploy the checks and we let them go quiet for a minute, we immediately start to use our network and see how can we get them more customers of their top profile. So whatever their A profile or their number one profile of their most profitable client, we're going to start to see how can we get introductions to them and become an active part of their network, driving business to them if and when at all possible. After that first 18 months to 2 years, we and aligned with their growth plans, we immediately start to do positioning for their next exit out. And so we don't stop getting them customers. We work hard to continue to position them in places, but we also start positioning and curating relationships that will be good, healthy partners to refinance them out or grow them to the next level. And we remain active with them, getting them customers and positioning them for success all the way until exit.
Ownership, control, and support. I love it. And I love how succinct it is too. You did a great job of talking about and making clear what the value add was. And so if we can unpack the support side a little bit more, earlier we were talking about how the reality of today, we operate in a very dynamic environment, and you need to constantly be maybe not necessarily changing, but anticipating change given market conditions. Obviously, artificial intelligence, significant disruption, and so would love to get, your perspective on how you're finding it's impacting customer acquisition.
Yeah, in one sense, AI, I think I know a lot of people are view it as an extraordinary opportunity, um and a lot of people are scared of it, probably rightly so. I think we should be weary of something that's become so smart on its own. We've all watched the movies, but if it's not, though, if you're not using it to bring change to your productivity, you're going to get left behind. You have to. It's like, not using the paved road and insisting on being on the dirt road next to the highway. You have to use it because of the world we live in today. But it's all about making sure, in my opinion, that you figure out how to use it for you to boost your own productivity. And you don't need to necessarily, I think there's a real distraction out there today for a lot of the founders thinking, well, how's everybody else using it? It's this search to find their footing with AI, which you just got to start to use it to help you. Just think productivity first. How can I how can I become more productive? So for us, if our thesis is customer acquisition and selling revenue, our first thing is how can this help you sell more? How can it help you easily define your customer profiles better? How can it help you analyze the buying practices and moments? I mean, if there's ever been a time to fast track your information about your customers, it's now.
Yeah.
And how are they interacting with your product? I think there's a big opportunity, and it's going to get less and less expensive to have AI help you understand your customers' buying habits and use habits and what they're going through. There's the feedback loop today is extraordinary if you have AI helping you. We can do and understand things faster than anybody else. And I think it's not just a that'd be nice. It's like you're going to have to do this to survive.
Yeah, I mean, I think you do a really good job of illustrating is that you don't necessarily have to think of um, artificial intelligence as a product that you're selling, but rather a means to support an existing solution set. And that I would also agree with you. The time is now. You know, it's been a reoccurring theme on the podcast. I see it in our normal course of our business. And so agreed. Um, Anything else, so notwithstanding AI, would love to get your perspective as we sit here now in April 2025 on what you're bullish on, either industry wise, or other themes on the horizon. Obviously, please don't reveal any trade secrets, but or anything that would push you at a disadvantage, but would love to get your perspective on your outlook.
Yeah, no, I'm open book on anything. I think we're just one of the beer stands on the beach, where like, information today is out there. So I can't think of anything that I need to hold close to the vest, but uh, uh, bullish on bullish on teams that I continue to remain bullish on teams that can sell and who are going to have customers irrespective of to how AI and tech are playing out. So we're right now really looking for businesses that might not have as high of a valuation. I think to acknowledge the elephant in the room at this time in season in 2025, there was a lot of really high valuations in 2021. There was a bit of drunkenness with private capital and the valuations of the businesses. And unfortunately, right now, for anyone raising money, either in a fund or for their own company directly, it's very difficult to raise money right now because there's so much liquidity tied up in these exit events. So this is affecting the amount of capital available to direct companies, which is, you know, it's reducing the supply of capital, so supply of buyers essentially into your businesses and into your funds, so that valuations are going to have to come down. So I am bullish about, from an investor perspective, being able to buy right pricing. That feels good, that there is a reset that has to come. And I would encourage businesses that have to lower their valuation. It doesn't mean the end of the world for that. There are a lot of things that you can do to protect your valuation if you need to lower it. It doesn't mean like you're giving away all of your company. There are investors like us who are willing to do things on convertible notes and that to help you grow your valuation. But I'm bullish on businesses who are willing to kind of right side their valuation, but are can still bring in revenue and maybe do it a little faster because of AI, even if they're that plumber or, a skilled trade, or they're selling muffins, or they've got the next jet or the next tech thing. Everybody is always sort of thinking, "Oh, the only thing that gets invested in is tech." Well, that's not true. There's a lot of investors out there like us that are very practical, and if you can get customers and get a revenue going in here and you have enough customer demand lined up to ride you through what happens with AI next month, we're really bullish on you. We'd like to get behind you because there is a population that's going to take some time for market adoption. Not everything is going to go flying over to one side. So I'm really bullish, and so is Natalie, on anything that is open to a right-sided valuation where they're getting revenue in. They don't have to be the next Facebook, you know.
I think that's great perspective, especially I think too for the founders in a room, because sometimes they have misconceptions of what it is they need to come to market with to be the next, Uber, Facebook, what have you, and that no, there's tremendous opportunity in lots of places, and sometimes a single, a double, triple, can be just as great as a home run, especially when you consider the market environment. Couldn't agree
Yeah.
more.
I would always consider also, something that we like to see from founders, if founders are listening to this, is consistent investor reporting. And we would encourage any new founder to get in the habit early of starting to do quarterly reporting on some of the main goals, what's happened in their last quarter, and what are they working on for the next 90 days. That simple discipline and building that out drives investor confidence up. If I was given two founder teams, two entrepreneurs, and they were like in every category, and one could show me a history of some previous reporting that they'd done, even if they didn't have one stakeholder to send it to, if they had internally did, I'm definitely picking the one that's stopping to document. Here's
Yeah.
our marker that we did, and here's our goals for the next 3 months, because the world flies by, and pretty soon you're off and running, and 6 months, 8 months goes by. It's very hard to document your journey, good
Yeah.
and bad. Lays the foundation down, and that's another thing I like to see. If I've got a founding team that's documenting their journey, I know that they're likely going to be a good communicator with me.
And do you feel I couldn't agree with you more? We absolutely encourage our clients to do the same exact thing. I'd love to know, do you feel like the ecosystem is mature to the point where founders, accept that it's okay to not only pass along good news, but not so good news?
Mm, no, I think in human nature, they always think they're the only one that's ever experienced that problem. You know, I think everybody always wants to present to they always want to be best dressed. And I think a lot of founders, we were just talking about this morning with some other investors and founders, is that I think there's this sense, especially if you're trying to be a good founder and you've set this goal and you didn't make it, there's this sense of like, oh my gosh, I'm embarrassed I didn't do what I said I was going to do, whether it was something of your own fault or something that you couldn't control. Well, I think the founders need to be aware of is that likely your investors have seen a lot more than you think they have, and they they understand more than you think you do. And if you're always presenting like nothing's wrong, they're going to start to think something's wrong because like it's not possible that you can't be the only one living in a bubble. So if I'm a fund manager and I've got 18 of them going, okay, this happened to me last week, all different things, and I've got one who's their life is always perfect, I'm going to start to be suspect of like what's going on with this founder, because like they're not telling me the truth. So it's really important to know that it's okay to be real. Where I think we investors get sideways is if there's a constant problem, no solution offering. We all know that problems are happening within their control and not. And we need our founders to make sure that they know that they need to try things, and there's going to be waste, there's going to be mistakes, but to rebound back and say, okay, this is what I learned from it, and this is what I'm going to do differently. That's normal.
Yeah.
It's not normal to just say, "Oh, I'm everything's fine. I'm doing fine." Then something's not right. So it's normal to talk about all the lows. You have to have those, and it builds a relationship with your investor, and your investor might actually have some solutions for you or some tips. Sometimes not, but often they do.
Yeah. That's great. I mean, founders take heed, 100% agree. And really practical too. I mean, there comes a point you do a follow-on round and you go to your existing investors, and credibility is really important. And yeah, I think it needs to be said that nothing goes up straight line.
Right.
Um, it's a sine wave. And obviously you hope it's going in the right direction, but I think point well taken. Um, Rami, it's been a great podcast. One of the questions I love to wrap up with is, if you had an opportunity to go back and have a conversation with your younger self, what would you share?
Mm. Well, I would get into private investing sooner than I have. I also uh, I would save up more, so there was more cash to use, so I could take longer and be more selective about investors, get to know them more. I'd realized that networking for investors and stakeholders takes a long time. It takes a long time, and uh, you need some cash to have some staying power to network and get yourself in the right places so that you're rubbing elbows with the right people, and that does take some cash. But I would do it sooner. I would take risks sooner, and know that failing is okay and normal. I would tell myself that, and that nobody expects you to get it right all the time. But they expect you to kind of stand back up and go at it again. I think I put way too much pressure on myself early on to not let people down and not make a mistake, and I would spend way too much time doing that with if I would have just dropped it and put it down and said, "Okay, well, that was a train wreck," and got back up and said, "Okay, but now I know this, this, and this," and dealt with it quickly instead of trying to go back and fix it. Some things they just need to be acknowledged, you know? I was trying to go from here, this city to that city, and I got T-boned it twice in it. No sense trying to make that not happen. It did. Get up, get in another car, and we're still going to that city. I think I spent way too much time evaluating what went wrong, and a message to myself would be history is history and needs to stay there for a reason.
Yeah,
Grab the wisdom, but you don't need to bring it forward. You can still get to your destination and just take the wisdom that you had. You don't have to go back and fix everything.
I
So
love it. That's great. I think that's great insight and counsel. Thank you for sharing. Um, Romy, if there are any members of our audience who'd like to get a hold of you, how can they find you?
yeah, sure. They can email me at Rami at Francis Ann Capital, and they could phone me. I'll give you my phone number. It's area code 239-244-1122. That's the Francis Ann line. Feel free to reach out. They can connect with me on LinkedIn. Um, I don't check LinkedIn as much as I should, probably once a week or there, but they feel free to reach out. Anyone who wants to talk to me, I'd love to have a chat.
Fantastic. Again, for benefit of our audience, Romy Kochan, General Partner of Francis Ann Capital Partners. Romy, thank you so much for being a guest on the podcast. Appreciate your
Yeah.
time.
Christian, thank you for having me.
Kristian Marquez here. Thank you so much for listening to the Innovators and Investors Podcast. If you are a successful founder or an investor who would like to be on the podcast, please visit podcast.finstratmgmt.com. If you know someone that would be a great guest, please tag them on social media to let them know about the show and include the hashtag Innovators and Investors. I'd love to see your posts and suggestions. We're regularly putting out new episodes and content. To make sure you catch each new episode, please subscribe to the Innovators and Investors Podcast. And your thumbs up, ratings, and reviews go a long way to help promote the show, and it means a lot to me and my team. Would you like to know more? Go to our website, finstratmgmt.com, or follow us on LinkedIn or on X. Our handle is @finstratmgmt. This is Kristian Marquez. Thank you for listening. Until next time.